Hi. Recency bias is set up to wallop investors if they're looking at the T-bill and chill playbook to make investment decisions for next year. Let's look back. In 2022, bonds lost value as the Fed raised rates. Until a month ago, bonds were losing money this year too, but have recently shot up in value and are currently up, although still below values of 2 years ago. At the same time, Treasury bills went from paying next to nothing to a whopping 5.25%. Treasury bills did great, bonds did not. Now, however, we have the opposite situation potentially playing out. Let's compare where we were in December of 2021 to where we are now. In December of 2021, federal funds rate was near zero. Aggregate bond yields were around 1.75%, high yields around 4.8%. As of the end of November, federal funds rate was around 5.25%, aggregate bonds were around 5%, and high yield bond rates were around 8.5%. Let's look at some scenarios where agile fixed income strategies like ours may thrive. A hard landing accompanied by a hard recession. Equities and high yield bonds would likely suffer. The Fed would probably lower rates. If a strategy can allocate to aggregate bonds like ours can, investors could potentially earn a favorable yield plus appreciation as rates move lower. A soft landing accompanied by less severe recession. Similarly, stocks and high-yield bonds would likely lose value, while aggregate bonds potentially earn a favorable yield plus appreciation as rates are lowered. No landing with tame inflation. Under this scenario, high-yield bonds may do well as markets moderate and the Fed lowers rates to no longer become restrictive. Lastly, no landing and the reemergence of inflation. Equities may falter as the Fed holds rates steady or moves them higher. In this case, if a strategy can allocate to T-bills, as ours can, this may be the best performing asset class, an okay option as short-term rates remain high and may move higher. Over the past 2 years, T-bill and chill has been the winning trade. Over the next year, that's not likely to be the case. In 3 of the 4 scenarios I discussed before, aggregate bonds or high-yield bonds, or even better, strategies that can move adaptively among these asset classes may be the most likely to produce gains. In summary, bonds had bleak prospects 2 years ago. Today, not so much. Thanks very much. Take care.